Hello, everyone. The topic today is going to be why wealthy individuals set up foundations and how foundations work. My name is Michael Ruger. I'm the managing partner of Greenbush Financial Group, and with me today is Dave Wojeski. He's the managing partner with Wojeski Company accounting firm. The reason why Dave's here today is he deals a lot with mergers and acquisitions over on the tax side, and he deals with a lot of these business owners that sell their company and set up foundations as part of their charitable giving plan. So I guess right off the bat, like, how do these foundations work in general? Like, how do foundations operate?
Well, first thing really in any of the charitable foundations is charitable intent, right? The people have to have a charitable intent because it is a big tax savings in the year of a transaction when your income's the highest. It's the time you obviously are looking at other things to save taxes. But even in a tax savings, you're still missing the other portion of that income that you're saving. So if you give away $1 million and you save $400,000, there's still $600,000 that you don't have in your net worth. So, I think most people who have a transaction generally have some charitable intent because they have extra money and they realize that they've been fortunate enough to have a transaction and they'll look at different ways of doing it. So there's really a couple different ways several different ways. Honestly, there's those people that have a favorite charity that maybe they like to support autism. They know an autism charity that they'd like to fund, and they can just fund that with cash and securities, which we'll get into the differences with those later on. They could establish their own charity. So they could establish a public charity, which they could accept contributions to actually run a charity. So they could start a autism charity themselves, fund it themselves, get a charitable contribution for the funding, and then actually operate it, whatever that is for the public purpose, which is a lot of work. Like that's an actual another job and a charity. Yeah. And then there's those who really want to provide charity to the community, but they don't really know what it is. They like to help the community as a whole, which is several different charities. They could form a private foundation. And so form a private foundation, they kind of control the money, and then they just make grants. So they don't really have responsibility for doing anything for the charity. They just are providing grants to other charities. Gotcha.
So they could fund this thing with $1 million, and then that could set me up for all my charitable giving, both now and for the rest of my life.
Yeah. Okay. Yeah. I mean, if I always gave away $50,000 every year, and I had a transaction that was $2 million. Well, maybe instead of giving away $50,000 one year, because now I have this $2 million income year, maybe I give away $500,000 to a foundation, which is 10 years of that $50,000.
Right.
And I use the foundation to make the $50,000 gifts every year after that. And the reason being is you're matching your high income year with a high deduction. And it's the most efficient way to save taxes.
So besides just the tax deduction they get by funding the foundation and kind of that charitable intent, are there other reasons why wealthy individuals will set up foundations as opposed to just saying, hey, I'm just going to give to charity sporadically each year?
Yeah, there's a lot of intangible and those that are personal. I mean, if you have a big exit and people generally know you've had a big exit, you're a target for people coming to you and asking for money.
Yeah.
And most people have a good heart and to say no. Every charity is good, right? If it's a charity, it generally has a good purpose. It doesn't mean it's your purpose.
Yeah. And
so people will often, I have to field another call from somebody looking for a charitable contribution. Right. And it does, if you have a foundation, your answer can be, well, we deal with that at the foundation level. We have a board, because one of the ways a foundation works is you don't own the foundation, right? A foundation is a separate entity and you don't have ownership in it. It's run by a board, right? So you have directors, or a director at least, and they would make the decisions on who gets the charitable contributions, and at least to flex it.
Yeah.
And honestly, if you're getting that many requests for things or for donations, it's much better to know to meet maybe once a month or once a quarter and decide what you're going to donate to, because you'd still have a budgeted amount. Even if the foundation gets $1 million, it can't give $1 million out every year.
Right.
It's going to give out whatever it decides to give out.
Now, you just mentioned the board, right? So the foundation is run by a board. I'm guessing the person that made the major donation is usually on the board.
Yeah.
But did they have to have a certain number of individuals that are on the board in addition to them? Or
it's a legal question. It's state specific. It's at least one, obviously. I'm not sure what New York is. I think New York's one.
Gotcha.
But a lot of the people are using it to bring their family into it, right? To say, okay, I'm going to create this foundation. I have children that are probably just getting into the business world or maybe even college. it's a good way to teach them about philanthropy. It gives them a role in the community, learn a little bit about the community, and you kind of are working together, teaching your kids. So that's another reason for doing a foundation, is that you now are doing something as a family, and educating the kids at the same time.
Now, we've seen people set up foundations and there's actually a payroll, because some of these foundations are large and some of the family members are on the payroll. Like, how does that, like, employing family members that are actually doing work for the foundation, but I'm guessing there's like real limits to, like.
Yeah, I mean, the IRS, everything that's, they're self-dealing rules. So the IRS is going to make sure that you're not setting up a foundation to get a tax deduction and then take all the money back at some point or redistribute it to your family by, jobs that are overpaid. So there's anything that is self-dealing. So anybody that is made a major donation, or that is on the board or a director or a family member is going to be scrutinized for self-dealing. And that doesn't mean they can't get a salary, right? Because if you have a foundation and it's part of your mission to get checks out and to vet all the requests, there is a cost to doing that. So if there's a reasonable pay to a family member in a foundation, then you can pay. You're not going to make a $250,000 salary for somebody who's working 5 hours a week. But if you use common sense and anything that's self-dealing, so you investing in your own business, you renting from yourself, anything related to that, there's specific rules whether you can do them at all, like renting you can't, or if you can do them just in fair market value or in small enough increments.
Gotcha. Now, for distributions from the foundation, we're just talking about money out. If I fund this thing with $1 million, is there a minimum requirement in annual grants that I have to make? They say, hey, if you've got this foundation, you can't just keep accumulating. Is there a distribution requirement every year?
Yeah, I mean, one of the benefits of the foundation is, again, it's a nonprofit, right? It's a 501c3. So it gets the money that grows in there is growing tax-free, right? So the value of you having $50,000 a year and giving it in at $50,000 doesn't grow as fast as if you put $500,000 in. And it grows tax-free. That's one of the requirements that allows it to be tax-free. And there is a small net investment income tax, but it's relatively small. It's 1.49%, I think, of the net investment income that you still pay tax. And that's really for the IRS to administer these. At the IRS level, it's supposed to be like an admin charge. But providing you meet all the requirements of being a foundation, which is 5% of your assets are distributed. So if you put $1 million in, then you need to make charitable contributions or grants of $50,000. There are some deductions against that $50,000, but generally it's 5% of the gross assets of your foundation needs to be distributed each year, or there's an excise tax that's expensive.
Gotcha. Now, when we say assets of the foundation, they can be invested. Like, how are foundations usually? What are the assets that usually make up the? Or does it really vary a ton?
It varies. Most people will contribute securities or cash. So once you contribute securities and cash, if you have cash of $100,000 and you have securities of $1 million, your foundation's worth $1.1 million. And 5% of that, $55,000, would be your minimum grant distribution in order to comply with the foundation rules. But you can put a building in there. You can put closely held stock in there. You really can put anything, any asset in there. Cryptocurrency can go into the foundation, and then it's just an asset, and then the foundation has to do whatever the foundation does.
Now, when you're first funding that foundation, is there a tax incentive to, like, appreciated securities? I'm going to fund this thing with appreciated, as opposed to just, hey, I'm going to write a check for $1 million to fund my foundation. I bought Apple stock like 20 years ago, and it's worth $1 million and has this huge gain. Like, how does that work with appreciated securities funding a foundation?
Yeah, I mean, when we talk with people to make these contributions, it's almost always it's appreciated securities. And the way it would work is if I wanted to make $1 million contribution and I had $1 million in cash in my checking account and I had $1 million of NVIDIA stocks, since that's the one that seems to be most appreciated these days, and I owned it for $10,000, it's the same $1 million into the charity, but I can donate the stock, still get $1 million tax deduction, and then I could take my $1 million in cash and rebuy that NVIDIA stock. And now my personal position is the same position it was before. I own $1 million in NVIDIA, but my cost base is $1 million.
Gotcha.
And the charity gets $1 million. And there's rules around the charitable contribution amount you get for donating stock. It's limited, but if your income is high enough, then it still makes sense, because you get a 60% deduction for making a cash contribution, soon to be 50%, but 60% of adjusted gross income.
Okay.
So if I make $100,000 and I donate anything less than $60,000 in charity, I can deduct all of it. For appreciated stock, it's 30%. It's 20% a private foundation, but 30% for a straight public charity. So that same scenario, if I made $100,000 and I donated a $60,000 of stock, I could only deduct $30,000 of it because I'm limited to 30% of that $100,000. But it carries forward for 5 years. Okay. So it would still make sense. It almost in all cases makes sense to contribute appreciated securities if you have them. Providing you're not going to lose out on charity over that 5-year period, including the carry forward.
Okay. So we've talked about some big numbers. And I think one of the misconceptions out there is you have to be like an uber ultra wealthy, $100 million type person to establish this private foundation. Like, where is kind of the funding level that you see that actually doing this private foundation makes sense versus people that use other solutions?
Yeah, I mean, you hear the Gates Foundation, which has whatever it has, $1 billion, $10 billion or something, at 5% that they have to give away is an awful lot of money. And most people, it generally was ultra high net worth people that have foundations. But the reason you can't do it with $10,000 is that there's administrative costs. It's a corporation. You have to set it up. There's administrative requirements. There's a tax return. There's that little bit of income tax, net investment income tax. But there's compliance stuff for operating those. I generally think you need like $1 million to set up a private foundation. And the reason being is for some of the smaller ones, we've talked about, like Fidelity has their donor advised funds. So if I want to make a $100,000 contribution, we could talk about why a lot of people are doing those donor advised funds now. That probably is a better solution, because if I'm going to donate $100,000 to a donor advised fund and then next year tell Fidelity where I want that money to go to, there's really no administrative costs other than Fidelity's 1%, I think it's 1%, the fee that they charge. If I have a private foundation, I put $100,000 in, I have to pay for the tax return every year, I have to pay for the startup costs. It's way more than the 1%. So you lose control a little bit, right? Because you don't have that board, you don't have your family.
You can invest in whatever you want, because usually they say, hey, there's some limitations as to what
but I think for $1 million, you're producing enough income to cover the administrative costs that it probably still makes it worthwhile. And I think the rule of thumb, some people say 2 million, some people say a little bit more. We have some that we funded with just $1 million, and they seem to be working. They seem to be working fine.
Now, you just mentioned donor advised funds. So everyone might not know what a donor advised fund is. So can you just give a brief background on why they've kind of gained in popularity and what they are?
Yeah, I mean, in the past, they've always existed, right? And it was another way, again, for less than ultra wealthy people to create kind of private foundations by, making one larger investment. But what's happened is when the in the latest tax act, when they increased the standard deduction and they also put a limit on the taxes, the SALT cap limit of 10,000, most people are not itemizing. So what happened was people they were making charitable contributions and not getting any tax deduction for them. So if you think about the married filing joint 2025 standard deduction of 30,000, I can only take 10 in taxes because I'm capped at it. So now I have to get $20,000 in itemized deductions, which is really just mortgage, interest, and charity. So even if I have a mortgage of $10,000, I'm still short $10,000. So my first $10,000 of charity is non-deductible.
Got it.
And the next, so if I do 11,000, I'm only getting a tax deduction for 1,000 of that. So what people do now is they say, okay, you're going to commit $10,000 every year to your church. Well, do you know you're going to do it for the next 5 years? And if the person says yes, and they have the money, we would say, then let's donate $50,000 into this donor advised fund. So the $50,000 reason that makes sense is now we have $50,000 in charity, $10,000 in real estate taxes, $10,000 on mortgage interest. We have $70,000 itemized deduction, which is much higher than the 30. We get a $40,000 tax deduction on our individual return, and we save taxes we never would have saved over the next 5 years. Right. So that's probably worth $16,000 in tax savings by fronting that deduction. And now what people always say is, geez, I don't want my church to get $50,000 all in 1 year. And I give them the envelope every week. They're used to getting $1,000 from me. And so the donor advised fund, like Fidelity has, put the money into Fidelity. Fidelity then, when you're ready to give the church money, you instruct Fidelity, hey, I want you to send, remember I gave you $50,000? I'd like you to now give 10 to my church.
Gotcha.
So you're still controlling where the money goes. And you're still getting to the same place, but you're just fronting the tax deduction. And because of that standard deduction, the donor advised funds have really grown like crazy over the last 4 or 5 years. I don't know the numbers, but
Yeah.
but it's large.
And they're invested, so you're benefiting from a lot of the stuff of the private foundation. But like you said, Fidelity's paying the money for their 503c that they set up to fund this whole thing, and everyone
Right.
just gets to subscribe to it
Right.
within their own bucket.
Right.
Yeah.
They're just in their administrative fee. They're managing the money, and they're taking care of all the administration you would have to do as you had a private foundation.
Okay. So if it makes sense to do a foundation, how long do these foundations live for? So I sell my company for $30 million. I'm like, okay, $1 million in the foundation. Like, does it go in perpetuity? Like, what's can it? Yeah, it's just like, so these things can live well beyond like the.
Yeah, as long as it's doing what it's supposed to be doing, which is getting rid of their money and giving it for charity and following all the rules.
Yeah. So you mentioned rule. So I sometimes will be like, what can foundations not do? That some people say, hey, I want to do this foundation. Well, you can't do that with a foundation. There's some.
Well, so most of it's around self-dealing, right? It's self-dealing in anything that's not charitable. So political, like lobbying, anything in the lobbying area, or the political influencing legislation. The purpose of it is to support community 501c3 organizations. So if you stay in that realm, you really don't have any problems. When you start creating benefit for yourself or somebody who's a major donor, so it doesn't have to be the founder. So if somebody decides to make a major contribution, they become a self-dealing person.
Gotcha. Yeah.
Because it can't be a quid pro quo.
Yeah. Awesome. All right. Good. Thank you so much for doing this. If you ever have any questions on these private foundations, the tax benefits, how they operate, feel free to reach out to myself, Michael Ruger at greenbushfinancial.com, or David Wojeski at wojeskico.com. Thank you.
Thanks.